Hi everybody, the most awaited IPO of 2022 is finally open for subscription. Yes, I am talking about the most talked one, the hot topic of the market, LIC IPO. Is open for subscription now, but are you confused, just like all of the investors, to be or not to be invested in this business or in this IPO? Well, let me try to clear your confusion. In this video, we are going to discuss the insurance as a sector, its growth trajectory, what are the key financial parameters one should understand and analyze before investing in any insurance business, and finally, how LIC is positioned amongst its peers in the listed space. This video is not only about the review of IPO, but it is more about the insurance sector and its growth trajectory and what is the future perspective of the insurance. Let's look at the history of insurance industry in India. Well, in 1956, all the insurance companies in India are nationalized and merged into one formed Life Insurance Corporation of India. From 1956 till about 2000, LIC was enjoying a monopoly in the life insurance space with 100% market share. It ended in the year 2000 when FDI investment in the insurance sector was allowed. That is when a lot of foreign companies tied up with Indian companies to offer insurance to Indian customers. And since then, LIC is slowly and gradually losing its market share against the private players. But currently, LIC is still standing at 70% of the market. But the big question is that whether it will be able to sustain this market share. Now let us look at the market size of insurance industry in India. Number one, insurance industry is a colossal one, and it has been growing at a rate of 15 to 20% year on year. Together with the banking services, life insurance contributes 7% of India's GDP. Number two, that overall premium of the industry is expected to touch 24 trillion, which is a huge market and a huge number. Third, according to S&P Global Market data, India is the second largest in insurance tax base in Asia Pacific. Now let's look at the competition of the market players. Since the opening of the FDI investment into the insurance sector, currently there are 57 insurance companies in India, out of which 24 are operating into the life insurance space and 33 to 34 are operating into non-life. Into the life insurance space, 4 companies that are listed in Indian stock market. Number 1 is ICICI Prudential Life, number 2 is SBI Life, number 3 is HDFC Life Insurance, and number 4 is Max Life Insurance. Now the latest one is LIC, which is open for subscription. Two major factors that is very important for any industry to flourish is number 1 is structural support from the industry, and number 2 is the penetration level. Indian insurance sector has a huge growth potential. Reason being, number 1, the insurance penetration level in India is very low. It is just 2.4% compared to 3.17% across worldwide. Number 2 is the shortfall in the protection margin is the highest amongst all the countries. That simply implies the inadequacy of pure protection coverage. Number 3 is increase in population, largely the working class population, because this opens up a lot of opportunities because this particular segment needs protection as well as saving. So there is a lot of structural support and a lot of underpenetrated market, which is a huge runway for insurance sector to grow in India. But what are the entry barriers in this segment? The number 1 is huge capital investment is required to set up a business in this industry, and number 2 is the stringent regulatory guideline need to be followed. Despite these two major strong entry barrier, there are a lot of competition. As I said, currently there are 57 companies are competing in India in this particular space. Hence, 3 important aspects plays a major role. Number 1 is the price differentiation, number 2 is the brand trust, and number 3 is the claim settlement ratio. These 3 major factors plays an important role for any individual company to scale up its business and gain the market share. Now 5 key financial ratios that one should understand to analyze the value of an insurance company. Number one is embedded value. It represents the sum of the present value of all the future profits that a company generates from existing business. What does it mean? It means buy an insurance today, you continue pay premium for several years, and it is from the future income the company generates profits. Hence, company value is associated with the future profits. The company has a market capitalization of 1000 crore and the embedded value of the company is 250 crore. It simply implies that investors are willing to pay 4 times of the embedded value. That means that investors are very bullish in this. The big question is that can LIC make a debut with 2 to 3 times of its embedded value, which its predecessor has enjoyed during the time of listing? Number 2 is NBP. It's called New Business Premium. It signifies the growth in the insurance business in terms of new policy being sold, excluding the renewals. That means the number of new client acquisition. Now, in this NPP space, LIC shares stand at 66% in FY21 compared to 52% in the previous year. That means that NPP shares for LIC is growing. VNP margins, value of new business margins, signifies how much profit the company is expected to make from the new business it generates in the future. Now, BNP margin for LIC stands at 9.9% for FY21, which is 2 to 3 times lower than the private players, which stands at 22 to 27%. The fourth ratio is called persistency ratio. It will help you to understand how persistent the customers have been in terms of renewing their policy year on year. In terms of persistency ratio, the LIC stands in line with the industry. Now, fifth ratio is called solvency ratio. This ratio will help you to understand that how much buffer the company has to settle all the claims in terms of extreme situation. Now, in terms of solvency ratio, LIC also in line with the industry standard. Now, these are the 5 ratios investors should understand and analyze before investing in any insurance business. Let's look at the 4 points of concern for LIC as a shareholder. Number 1 is higher share of traditional plan. Experts believe that higher share of traditional plan will come in the company's way of getting 3 to 5 times of EV multiples. It is because that LIC has the higher share in the traditional product mix. It is considered a liability because LIC has to pay back this money to the policy holder of money back policy or other saving schemes at the time of maturity, whereas the private players has the higher protection schemes which brings a lot of profit. Number 2 is the LIC's profit sharing arrangement is at a ratio of 95:5 for the policy holders and the shareholders for the participating business, whereas the same ratio is 90:1 for private players. Number 3 is LIC has the largest agent network for selling their policy. Once a strength turned out to be a weakness with the advent of digitization and the new distribution channel. LIC's agent network stood at 13,53,808 as of FY21. Such a huge independent agent network comes with a cost. LIC's commission ratio, which is gross commission to gross premium, is at 5.4% compared to 4.5% for private players. Private players are using more banker assurance modeling for selling their policies, which is nothing but an agreement between insurers and the bank, where insurers are allowing bank to sell their insurance to the bank clientele. Now, LIC is very lackadaisical in adopting the new business model, new channel of distribution, because LIC's agent has built the LIC in the last 65 years, this independent agent network, and adopting the new digital platform or new channels for distribution LIC's policy, LIC do not want to sideline their independent distribution. And very important is, even after post listing, government will be a major shareholder and key manager. Hence, government intervention into the business will be inevitable, which will be detrimental for the shareholder perspective. Now, let's look at the 3 positive points for LIC. LIC is the largest insurer in the gross written premium, GWP, and the new business premium, NBP. The new business premium for LIC stood at 66%, where the nearest player market share stood at 9.16%. Number 2 is LIC ranked 5th globally in terms of GWP and 10th in terms of total asset. And number 3 is, despite losing the market share against the private players, LIC still stood at 68 to 70% of overall market share. That means that 70% population is still trusting LIC as a brand, still willing to go for LIC's product, which is a very positive sign for LIC. Now look at the other parameters against its listed peers. Here come our Excel. LIC versus the private players. There are 4 private players which are listed in Indian stock market: ICICI Prudential, SBI Life, and HDFC Life, and the new one is LIC, which is going to list very soon. Now let's look at the metrics and how LIC stand against its listed peers. Now there are a lot of metrics I have written: stock price, market cap, embedded value, EV multiples, EPS, net profit, net worth, P ratio. Now you can look at this entire Excel and you can understand how LIC is positioned against its peers. Now if I have to look at the important metrics, which is embedded value and EV multiples. Embedded value for LIC stood at 5.4 lakh crore, whereas EV multiples is 1.11. That means that investor is only willing to pay 1.11 times of the embedded value, whereas the LIC HDFC Life embedded values stood at 4.06 EV multiple, whereas HDFC Life EV multiples stood at 4.06, SBI Life stood at 3.36, ICICI Life stood at 2.5. That also implies that LIC is currently positioned as a discounted rate, which also means that LIC is currently positioned at a discounted rate. But if you look at the net worth and the net profit, you will see that LIC has the highest net profit, which is 2,974 crore, against HDFC, SBI, ICICI, which are almost half of the LIC's net profit. P ratio, which is a point of concern, because all the 3 P ratio is in the range of 99 to 100, 102, whereas LIC's price to earnings ratio stood at 201. And the stock price of LIC stood at 9.49, which is the upper band. Market capitalization terms also LIC is the highest, which is 6.0 lakh crore. So market capitalization is 6 lakh crore almost. Embedded value is 5.4 lakh crore. EV multiple is 1.1. EPS is 4.7. Net profit is 2,974 crore. Net worth is 6,514 crore, and P ratio is 201.9 crore. Amongst all these things, only P ratio seems to be very expensive amongst its peers. Apart from this, net profit and EV multiples seems to be, net profit is very good, and EV multiples seems to be placed at a discounted rate. Now to summarize, the key trigger point for LIC is to improve the protection segment, which is very important for growth of LIC. It also needs to take steps to increase the upselling, cross-selling and digital selling. Now investor must be aware that insurance business is long-term in nature and its value is assessed on the future profit it generates from the existing business. Hence an investor must have a long-term view or must have a long horizon and long investment horizon before investing in any of the insurance business, be it LIC IPO or be it the existing listed players in this segment. But one must have long-term view before investing in this segment. That's all about today's video. If you like the content, please hit the like button. Do subscribe us. Jai Hind, Jai Bharat.